Okay, so today I will go through with you three stocks that I've just noted, and I'll just show you how to do basic research of that if you have no clue about it. So these are the symbols, so I'll just go through with that. I'll take the first one as an example, and I'll just copy that and paste this simply into Google and write stock besides. And I can just find out the name of the stock, which is Biogen. It's a biotechnology company. And then I can see what it was traded for lastly, and I can see it's $240, and that's the last trade, $240. So I'll just change that to 240, for example, and then I want to know when it was boomed, so or founded. I can see here, okay, it's simple in Wikipedia, so that's a Wikipedia thing, founded in 1978. So I'll just write that besides that, and then I know it's healthcare sector, okay, and then I want to know the book value. If the book value is more than the price rate, then it means that it's the stock is good. Like I'll just show you. For example, I'll just go to another website called Macro Trends, and I'll just paste the symbol here. Select that, and I can see that the price. Yeah, that's here it is. So I can see that the book value price book ratio is 3.34, which means that the stock is nearly 3.34 more priced than it should be. So it's like 3.34 times more price than it should be. So the price is high. And if I look in 2015 March, it is 7.85 times more. So the people who are buying the stock in 2015 March are paying 7.85 times more than what they should pay, so which is very expensive. But in 2006, they are paying twice more than what they should pay. So right now, the stock, if somebody buys the stock of Biogen right now, they will be paying 3.34 times more than what it should they should pay actually. So it's more expensive, but it's compared to 2015, it's less expensive, but still it's not. It's still more expensive. Now let's look at the debt ratio, debt to equity ratio. I'll go to other ratios. I can just click on debt equity ratio, and then we'll just have a look. And if I just have a look at that, I can see it is 0.43, which is good sign because debt to equity ratio, if it's zero point 0.5 or less than that, that means that the company is doing good in terms of debt. So so that means it has controlled debt. So if you see in 2015 it was 0.05, which is brilliant, and then it took loan after that in 2015, and right now it's 0.43, which is less than 0.5, which is good for the firm. So debt to equity is really good. Then if I see um, return on equity, if it's more than 8%, then it's really good. So if I see it's 35.31%, which is really good, it should be at least above or equals to 8%. If I see in 2018, it's really good. It's going very good throughout. So the return is really good on equity, which is what we want. So if I see that, okay, in 2007 it was 8.97, okay, and which is really good. But in 2007 March, it was 3.2%, so which is not very good. But then it became good after June 2007, and now it's consistently more than or greater than 8%, and it's still growing. And now it's even though it reduced in 2017, but still it's way above 8%, and it's still growing. So that makes it very brilliant. If I look at the current ratio should be at least 1.5 or more than that for it to be safe. And if I just click on the current ratio, and if I just have a look, it's 2.84, which is really good. It's above 1.5, and it's safe right now. And if I just have a look at the trend, the previous trend, here, like it's above 1.5. I just go through the ratios. Yeah, so it's in 2008 it's about 1.5, but in 2007 December, it was 1.08, which is still good, but it's not very safe at that time to buy because it should be at least 1.5 for it to be risk free, maybe. And then, but as you notice that since it has been greater than 1.5 since 2008, it has consistently been greater than 1.5, which is a very good consistency, is very good for the firm. So it's been like now nearly 10 years or 8 years, 9 years or 10 years that it has been above 1.5, which is a very good sign. Then if I want to have a look, I'll just go to Google, and you can just see this. I've just typed this in Google, and you can see there's no dividend yields. Maybe they're not paying dividend at all. If a firm is paying a dividend, then it makes it very good because they have extra money to give to people. So it means it's a safe firm. It's making a lot of money. Um, then, if I want to have a look if it's a million or a billion market capital company, I can just have a look from Google like that. So it says it's a billion, 46.6 billion market cap, which means it's a big firm. And just for information, if I just go to Glassdoor, and if I just want to have a look at what reviews this firm has got in Glassdoor, okay, and if I just type in Biogen, okay, and type search, I'll just type in Biogen Glassdoor, okay, and if I just have a look, yeah, that's Biogen Glassdoor. I just Google that and go to Glassdoor, and then you can just have a look that it has 3.6 ratings, which is pretty good for this big firm. And you can go through and you can just read through the all the opinions of people, employees, and stuff like that to know like what the culture is about, if it's good, if it's not good. It tells a lot about the inside of the firm, which affects the firm itself. So you can just have a look. Some has very bad reviews, some has good reviews. So you can just have a look at that. And then if I just search this firm, Biogen, in Indeed, which is again a very big thing. No, I'll just click here, working at Biogen, and it's 4.1 star and it has 404 reviews. And this also tells a lot about the firm. And you can just read through the reviews and the pros and cons, which tells a lot about the firm as well, which is important to know. So Glassdoor has 3.6 review, and Indeed has 4.1. And you can just read through that, and then you can have a look at the patents. If the company has patents, which is patents would be I'll just go to Justia Patents, and okay, that's the website, Justia Patents. And if I just type in Biogen in search bar and click search, and then I can just have, just one sec, Biogen. I just want exact because some forms have exact name, very similar name, so you can just get confused. So I'll just copy that. So I've just copied that from Google, Wikipedia, and just search that Inc. And the assignee. So assignee means that this is the person who has the intellectual rights. So they own the patent, no matter whoever the inventors are. We're just looking at the assignee only. So Biogen has patents in 1994, and then in 2000, Biogen has patent. 1998, it has patent. 1995. So these are like old patents. I just want to see if it has recent patents because that means they are innovating right now as well. these are all, you can just go through that to see. So I think this biogen is different than what we're looking at. This one is different maybe. And so you can just go through if they have any recent patents, because they should be innovating right now as well, not only that they started with that. And then okay, so you can just go through with that. And then the management. So if you want to know that if the salaries of management has been revealed, which means if it has been revealed, that means that the firm is being transparent, and it's telling what the management salary is getting, which is very important. You can just go to Yahoo Finance, click that, and then you just type in Biogen. Okay, click that, search for that, and then you just go to, I think you have to go to profile, and you can just have a look at information like full-time employees, these many, the industry and the sector. And I can have a look that all the pay of key executives has been shown. There are five of them, and I can see all the pay of all of them, so which makes it more transparent. And then what else we have?